The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, joining us now here on the program, pleased to sit down and have a wide-ranging discussion about net farm income, interest rates, and things that are driving the markets and more here throughout agriculture. Joining us, David Widmar, economist with Agricultural Economic Insights. And David, it is always great to sit down and chat with you, my friend. I hope you're doing well. Hope you had a great Thanksgiving.
Thanks, Jesse. Happy to join you again this week.
Let's start with net farm income. I know you guys have been doing some work on that at AEI, and really curious your thoughts here and some of the work you've been looking at. Talk to me, just where do things stand right now? Is that net farm income picture, does it look good right now? What are we seeing?
It's been the best of times, but not everywhere, I guess is the best way to summarize that. We've talked about this before. Net farm income in 2022 was a new all-time high. Farm incomes from 21, 22, and 23, if you average those 3 years together, it's the best 3-year run that we've seen since the 1940s. I mean, in context, it's better than we saw in 2011, 12, and 13, the previous high watermark for most of our memories. But what we did is we looked at the state level story, and it's important to keep in mind that the state level data are heavily influenced by the commodities grown in those specific regions or areas. And so one of the things we looked at is, where have farm incomes gone up the most? And not a surprise to most listeners, it's been primarily in the Corn Belt and in the northern Great Plains. There's only one state that doesn't have higher income in 2022 compared to the 2016-2020 baseline, and that's the state of Washington. And then we looked at, how do 2022 state level incomes compare to historic context? And so what we can see is that, again, a lot of records have been set in the Great Plains, northern Great Plains, such as South Dakota, Iowa, Illinois, Ohio, Kentucky. Some of the records actually from the 2012 era, so Michigan, Indiana, Nebraska, have some lingering records. But then there's a whole nother set of records from the southern Great Plains and extreme north part of the country from the 1970s. So again, the takeaway here, it's been a really good time in agriculture, just not for every region or every commodity.
So I'm going to follow that up with interest rates. How much are the high interest rates that we're seeing right now in this interest rate inflationary environment? How much is that playing into some of the net farm income numbers right now, David? Can you expand upon that for us?
Yeah, so the most recent net farm income data comes from 2022. And that's, of course, when the Fed started raising rates. And these farm level rates really didn't start to get higher until the 2023 planting season and growing season. And so we've seen a sharp uptick from there. That's going to be a headwind. Unfortunately, we won't get those 2023 state level data until next winter or next fall. So we got to keep an eye on that. We've seen interest expense tick up sharply when it comes to the national data, but we haven't seen it at the state level yet.
Okay. So with interest rates there moving forward, are you worried about them having a big negative effect on net farm income moving forward? I guess, what's your take on the current environment here? I know we got a Fed meeting coming up here again in a couple of weeks. Wondering if they're going to start to cut, what they're going to do. What's your take on this interest rate environment as a whole right now?
We have two primary concerns right now in the interest rate environment. When we think about the farm economy we were just talking about, we've seen a sharp uptick. And that's because farm loan interest rates, like everything in the economy, those new loans are coming in at considerably higher interest rates than we've been used to. Now, the other thing that happens here is in agriculture, we have some debt that there's new debt, but then there's also debt that gets paid off and gets reissued. So if we have a farm that we paid off, we might go on and add new debt. So it's hard to understand how much of this debt is sort of getting is truly new versus how much of it is kind of being reissued at higher levels. So the takeaway there is we believe that farm level interest rates and expenses are going to uptick faster than it might initially seem. Now, a lot of the debt is long term, so it's going to take some years for that to roll through, but we're going to see the expense continue higher. The second piece here that we're really concerned about is long-term interest rates continue to go higher. So the Fed hasn't raised rates but one time since since June. The long-term interest rates have gone up more than 150 basis points. Think about the 10-year treasury. So on the short-term rates, we've seen the 25 basis point increase in the last 6 months, long-term 150. We anticipate some of these long-term loans, such as machinery or land, farmland, to continue to face higher interest rates in the months and all the way into 2024. So despite the Fed sort of taking a break the last 6 months, long-term interest rates still have upward momentum and they've been moving higher. And that I think is going to have a lot of headwind for the farm economy moving ahead.
I think a lot of those conversations here, if they haven't happened already during the month of December between farmers and ranchers and their ag bankers, could be some tough conversations out there the next couple of weeks ahead, David.
Yeah, I think it's really important for producers. The Fed meetings get a whole lot of attention, but for the farm economy, it's the long-term rates that are most consequential. Keep in mind that we have this inverted yield curve. What's an inverted yield curve? That's when short-term rates are at a higher level than long-term rates. That inverted yield curve started when the Fed started to raise rates. So that was a bit of a shelter or a shield. And so long-term rates haven't felt the upward pull as much as short-term rates. And so these long-term rates are starting to come out from underneath there, and the yield curve is becoming less inverted. So be prepared, be thinking about this. Long-term rates have been trending higher the last several months.
We are talking today with David Widmar from Agricultural Economic Insights. You can find all their great work and research at aei.ag. David, let's talk a little more about some of the things in the grains. I'll start with wheat. Wheat has been an interesting market to watch here in recent days and weeks. We set some new lows and then started to rally off of it on the futures board. I know we've been watching winter wheat planting happening, and I know you're going to be keeping an eye on some of those reports that come up in January in terms of how this winter wheat crop is looking here for this year, aren't you?
Yeah, there are two issues that we think are really important for the 2024 marketing year. One of them is soybeans and soybean oil, domestic crushing, and the other one is wheat. And wheat isn't a very popular crop for a lot of producers, but it's very important for big parts of the country. So when we step back and look at the 4-decade trend, it's been fewer wheat acres. And that doesn't happen in a vacuum. These acres aren't disappearing from production. They're getting converted into corn or soybeans or milo. So crops that are competing with the traditional feed grains and oilseed crops. One of the things we've seen since the 80s is about 1 million fewer acres of wheat every year. So we've been this big decline. Now, that's been reversed in the last few years. We've seen an uptick in wheat acres. Wheat acres are still historically low, but they're off their 2020 lows. So the big question mark is, where do wheat acres go in 2024? Because it's not a one-for-one trade-off, but if you think about 1 million or 2 million acre expansion in wheat, that means fewer acres going to corn and soybean production, and vice versa. If we see a drop in wheat, especially winter wheat, that's going to result in more corn and soybeans coming into production potentially in 2024. So we got to watch that really carefully. As you mentioned, the USDA's first estimate of winter wheat acres comes out in January. And that's really a first indicator of where this acreage debate for 24 is going to set up.
Well, you mentioned soybeans, soybean crush, and I know we're still waiting to see that major expansion happen. What's some of the things you're seeing going on with that? What's some of the work and research you're doing there right now?
Well, one of the things we think is really important for folks to realize is we've been talking about this biofuel versus, biodiesel or renewable diesel versus donut oil, fried food debate for the last few years. But if you really step back in the data, the amount of soybean oil, domestic soybean oil, going to biofuels production, this is renewable diesel and biodiesel combined, it's been trending higher since 2016. So this data, this trend has been in the data for quite a while. It's just now coming to the forefront. And this has been a positive demand source, has been a positive source of usage, and so we're going to see how this continues to play out. But as we're sitting here in November, end of November, 1st of December, it's a key reason why this price ratio is trending strongly for soybeans heading into 2024, both for the old crop we just finished up, but also that new crop we're getting ready to plant. So we'll see how domestic soybean usage, especially the crush and then the oil, starts to play out. I think the other thing to keep in mind is soybean oil exports have been down. The food usage of that oil has been pretty flat. So this has been the only new source of demand coming out of the oil side for several years.
Well, David, great thoughts. Before we wrap it up here today, anything final you'd want to add or reiterate to folks as they're just taking a look at everything here, this broader farm economy and the markets and more heading into 2024?
Well, I think this is a great time to not only catch up on your financials and get your taxes prepared, but to spend just a few extra minutes really thinking about what are the key insights. What did you learn here in 2023? What do you want to change for 2024? What do you want to improve? There's a lot of risk and uncertainty still out there, so we don't want to get complacent. And as we mentioned earlier, this interest rate environment is considerably different. We haven't spent very many years in our career in a rising interest rate environment, so we need to think carefully about the implications for our business and the farm economy as we move forward.
Well, I know folks can learn more at aei.ag. And with that, David Widmar with Agricultural Economic Insights. Always great to catch up with you and have a conversation. Thanks for joining us, David. We'll talk to you again soon.
Yep, talk soon.